and unpredictable, and restrictions of varying degrees have been announced at local, state, and national level in order to curb the spread of COVID-19. This has impacted sales volumes as outdoor and social activities were largely curtailed and continue to remain so. At the same time, this year we have been sustained inflation in input prices, especially palm oil, to extraordinary and exceptional levels. We have responded to this perfect storm by implementing both strategic and tactical initiatives. Let me give you an update on the various initiatives we have taken during the year. The first initiative is compressing the distribution structure. We have a three-tier distribution structure comprising superstockists, distributors, and retailers. This structure has evolved from the formative years of the company, wherever mother plant in Indore was located at the geographical center of the country, and we leveraged on low freight costs through reverse logistics to serve the rest of the country. We implemented a hub and spoke model through intermediaries like superstockists and distributors. As a result, the superstockist structure was created to serve as the first point of delivery from the plant, which would in turn cater to the next rung in the structure, which is the distributor. With the evolution into a distributed manufacturing model, we can now serve many of the distributors directly, thereby saving the trade margin paid to the superstockist and some overheads like secondary freight. We believe the savings could be to the extent of 200 to 300 basis points in EBITDA margin. This will be a permanent saving for the company, resulting in structural enhancement of the EBITDA margin. At present, over 95% of sales continue to take place with the traditional structure, and the initial benefits from the shift into the new structure will be visible during the current financial year itself. The second initiative is setting up of distributed manufacturing infrastructure. As you are aware, we have set up a 5-3P facility over the last 3 years. This has helped us augment capacity through an asset-light model, while also placing production more proximately to key consumption centers. Contribution from 3P facilities for the year stood at 24% compared to 8% 3 years ago. In addition to selectively adding 3P facilities, we are now focused on strategically setting up hubs at key locations across the country. These hubs will have the entire product range, which is an essential precursor to build direct distribution capabilities. During the quarter, we converted the 3P facility at Bangalore into an owned facility, which will now serve as a hub for the southern region. We plan to commission an owned facility at Kolkata in the second quarter of 22. This facility will manufacture extruded products and pellets to complement the existing facility in Kolkata for manufacture of potato chips. Production of the entire Yellow Diamond product range in this location will lay the foundation for direct distribution activities in the eastern region. On similar lines, we are planning to augment our 3P facility in Hisar to manufacture more products in the portfolio, which will set the platform for direct distribution in the northern region. Given the scale of our Indore facility, which has the entire range of products, we already have an established hub for the central region. The third initiative is enhancing distribution impact. Even as our distribution network steadily regains its momentum, we are enhancing efforts to optimize its reach. We have undertaken initiatives like telecalling, which are enabling us to deepen our distribution presence in micro markets and drive sales of a wider product range across existing outlets, thereby complementing reach of the existing distributor universe. This initiative has been introduced in certain markets at present and will be extended across our network in a steady manner. This will help us to sweat our existing distributors network better by capturing more retail touchpoints within the vicinity and also relentlessly engaging with retailers to offer more categories and variants of our products. A pilot for this was conducted in 19 and it has been elevated into a full-scale initiative in some key regions. This will be extended across more points in the network in coming months and quarters. The fourth initiative is on product portfolio. To further aid growth, we have recently made some additions to the product portfolio. The pandemic has exhibited that our products are largely consumed outdoors, and we are working on a strategic product initiatives to add some products which are readily suited to in-home consumption as well. We are also carefully evaluating our entire product portfolio to assess the impact of each on the basis of revenue contribution, popularity, and profitability. With this evaluation, we can then undertake bottom slicing to weed out those products that do not perform adequately on either or all criteria. During the quarter, we also launched our portfolio in some newer markets outside Gujarat. I'm pleased to share we have received an encouraging initial response and will build on it in a steady manner. The fifth initiative is cost rationalization and increasing efficiency. The adverse cyclicality in the prices of key raw materials, especially palm oil, has adversely impacted margins. We have partially mitigated these elevated costs through continuous operational and manufacturing process reengineering and cost optimization initiatives in both owned and 3P facilities. In previous quarters, we have also implemented initiatives to reduce per unit packaging material and also more efficient filling of corrugated boxes, which continue to provide benefits. Palm oil is a substantial cost item within our total expense. A 30% year-on-year rise in the average cost of palm oil would have a very severe impact on our margin performance, but the combination of the above factors has enabled us to largely offset the pressure and contain the impact to about 60 bps. In conclusion, I would like to state that the performance of Q4 and FY21 has to be viewed in light of the multiple headwinds being faced at present. However, we have tried to minimize disruption across operations. Further, the initiatives undertaken will strengthen the business model and benefits will certainly accrue in the months and quarters ahead. We are confident of a sharp rebound upon unlocking of restrictions. Reopening of schools and markets along with resumption of travel through trains and highways will bring customers back to point of sale. We also believe that the cycle for input prices will eventually turn into a tailwind. These factors, along with the structural improvement to our business model and permanent reduction in costs, will return us to a trajectory of higher growth and accelerated value creation. On that note, I conclude my remarks and we can open the floor for questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, to ask a question, you may press star and 1 now. The first question is from the line of Aditya Kondawar from JSP Investments. Please go ahead.
Hi, sir. The number one question that I had was, are we exploring any product adjacencies or new product entries in the extruded snack segment or on the sweet segment? Number two, just wanted some thoughts on the unorganized sector. What is the kind of competition that we have faced in the past from them? And in the past few quarters, what has been the competition like? Because, due to a lot of lockdowns, we have been hearing news that a lot of unorganized shops have shut their shops. So some flavor on that side, please.
Yeah. Hi, this is Subhashish Basu. As regards new product adjacencies, we are working on a few. In fact, we are working in extruded space also in shaped extrusions. As we are talking somewhere in a month or two, we'll be launching one product called sticks. Apart from that, we are also working on certain other products like rusk, which will also be a new product adjacencies, which we are just marketing now. And we are also working on some new sweet snacks at a different price points also to work on, which gives some innovations for the new thing for the market. At the same time, is complementary to our existing portfolio. In terms of unorganized sector, of course, there is some hit on the unorganized sector, and that however, the unorganized sector is too big in India to to die down. It will remain. However, they are also facing the headwinds like we are facing. And of course, as a larger company, we have a better wherewithal to handle this headwinds, and that's how we have managed to bring back our sales to our original level almost in the last quarter. I hope that answers my question.
Yeah. Thank you.
Yeah.
Thank you. The next question is from the line of Tejas Shah from Spark Capital. Please go ahead.
Hi, sir. Thanks for the opportunity. I hope the team is keeping safe and well. Sir, we have done a very good job of protecting or rather at least giving a good fight to gross margin pressure at EBITDA level by not conceding much of margins at EBITDA. So if you can highlight some of the factors or some of the measures that helped us to do this, and which of these measures you believe will stay with us when we go back to normalcy, let's say next year, hopefully by next year.
Yeah, hi Tejas, this is Sumit.
Yeah, hi, Sumit.
So, sir, we have done a lot of improvements, especially in the operation side so far. And some of them includes resize of our packet, change in dimension of our corrugated boxes, and these have multiplier effect. Moment I change my packaging, it also impacts the overall packaging cost, including the cost of these corrugated boxes, and it also gives some saving on the logistic cost. So we have done a large exercise by resizing all the packets wherever there was a possibility. In addition to this, we have also done some improvements in the overall operation side to bring more efficiencies in the production. In addition to these things, there is some grammage reduction in some of the SKUs. And apart from this operation side, we are also equally working on the channel side. So we have squeezed the trade margin whenever there was some possibility, and now we are working on a restructuring of a distribution model, which will give us another incremental saving. And most of the changes are sustainable. These are permanent in nature, irrespective of the commodity price.
And so based on your discussion with raw material vendors, especially refined palm oil, what sense you are getting for FY22? Are we seeing any chances of pricing coming down this year, or they are still hardening up like all other raw materials are doing right now?
Hi, Tejas, this is Amit here. Basically, the palm oil prices started from 70 rupees, went up to 140 rupees just 15 days back. It has now come down to a level of around 125. And I think the peak is gone. It can only come down from this place. It can't go up. Whether it will settle at 100 or 110, no one knows. It's very difficult to predict anything in oil. But in all practicality, if you see 5 or 6 year average, the average for this year or next year should not be more than 100.
And so last quarter average refined palm oil procurement price will be how much? Fourth quarter?
Fourth quarter average palm oil price was?
So, Tejas, the range was pretty wide. The range was from 90 to 93 rupees to 120, 125 rupees. But yeah, on a blended basis, the average would be roughly around 110 to 112 rupees.
Okay. So just wanted to understand, should we assume that if prices remain at this level, what Amit ji just mentioned, then our gross margin based on our pricing power and other interventions and trade front that we have taken will remain at worst, it will remain at this level, and then perhaps it can improve if prices go down further. Is that a correct understanding, or there could be many more volatile parts in this equation?
So as an organization, sir, what we intend to do is to improve the gross margin from here. However, considering the volatility in the oil price, it is very difficult to predict for a short term. For example, the oil price movement is very sharp. Like quarter 4, it went up to 120. But as Amit mentioned, even in early May, the oil price went up to 140 rupees per kg, which has come down to now 125, 126 level. So always there is some time lag between the improvement and the oil price increase. So short term there may be some volatility, because again it takes a little bit time to implement all the improvements which we have discussed. But yeah, on a long term, if I say from a medium term to long term, definitely we can see improvement in gross margin as well as in EBITDA margin.
Sure. And if I recollect correctly, we have a very decent impact of freight cost also in our total cost structure. So there's a decent inflation on that side also, apart from at the gross margin level. So any update on that side? And then I believe all the factors there are going up, freight cost and even demand in general the traffic is also picking up. So just wanted to understand over there, are we seeing any relief, or it is still hardening up there as well?
Hi, this is Subhashish here. In terms of freight costs, we have already done a lot of productivities in our logistics entire end-to-end supply chain. So to a large extent, we have been able to manage the freight cost inflation. However, the edible oil inflation is of much higher, has a much higher impact, and so there are some immediate pressures, because as Amitji and Sumit shared, the edible oil price is even higher today than that it was in Q4. So that will be a short-term pain. But in terms of freight cost, we have done a huge lot of productivity in our logistics supply chain, which we have been able to absorb and manage it.
Okay.
That does answer your question?
Yes. Good answer. And then last one, if you can share A&P number for the full year and fourth quarter.
Sorry to interrupt, Mr. Shah. There's a disturbance coming from your line. Request you to mute your line while the management answers your question.
Okay. Is it better now?
Yeah,
Hello.
Better. Can you repeat?
Yeah. Just wanted to know A&P spend for the full year and then fourth quarter.
So overall A&P spend for the full year is much lower than the last year. For FY21, total A&P spend is roughly around 8.5 odd crore for the full year. As you know, we largely spend for our rings, where these are regular advertisement runs on a kids channel. Since there is some kids are not moving out, so we have reduced the spend on advertisement for rings.
Got it. That's all from my side. Thanks and all the best.
Thank you, sir.
Thank you. The next question is from the line of Ritesh Jain from Birla Mutual Fund. Please go ahead.
Hi, good evening, gentlemen. Nitesh over here from Birla Mutual Fund. So I have a couple of questions. So Amitji, number one is on the price point of this the packaged snacks that your company is selling. Now, given the unprecedented cost inflation, be it the palm oil which you explained, or the freight, or the flexible packaging items, is there any discussion within the industry or within some of your large competitors, whether MNC companies or the domestic ones, to move beyond this 5 rupees price point, because there is a limit to which you can do this grammage change and the change in the packaging and saving through the corrugated box optimization and things like that. So this is the number one question. Or do you think still the large players are in the same mentality or the mindset to increase the sales and the penetration and not to think about the profitability at this point in time? This is question number one. Question number two is how much of Pratap Snacks sales or the revenue are directly linked to the say school and colleges, near school and colleges sales. I mean the retail touch point near the education thing. It's a difficult question to ask, but you still would have some idea. Is it 15% or 20% in a given normal year, non-pandemic year? How much this kind of things? Because I guess my sense is that school thing, I mean the packet with a toy into it is a high margin product for us, right? So these are two questions for you.
Sorry to interrupt, Mr. Jain. There is a slight disturbance coming from your line. Request you to mute your line, sir.
I have muted my line. I hope you heard me.
Yeah, the question is clear. On the first question,
okay, fine.
On the 5 rupee MRP product,
Yeah.
still large part of the sales for most of the manufacturers in the country come from the 5 rupee segment. For us, probably it would be close to 75-80% of our sales from the 5 rupee segment. And there is still lot of cushion available in reducing weight. So I don't think the 5 rupees category is going to vanish anytime. Though most of the players are thinking to reduce their dependence on 5 rupees and increase the 10 rupee and 20 rupees sales, we're also thinking on the same line. So we were, 3 years back, we were probably close at 90-95%. Now we are at around 80%. On the second question, we don't have the exact number of the touch points near schools or colleges, but I believe 20-25% of our sales used to come from nearby schools and colleges.
Okay, fair enough. And if you can allow me to ask one last thing, question. So, sir, I want to ask you the cost inflation, be it the palm oil or the flexible packaging or the freight. Would you believe that the current CMP or the current prices of some of these commodities are already into, say, Q4 numbers, Q3, Q4 numbers of Pratap Snacks? Or you think even going ahead in the coming quarters, they are yet to reflect into the company's P&L? Or, I mean, in terms of the inflation, the cost side, is the worst is already there in the numbers, or they are yet to come because of some inventory or some other stuff?
I think probably Sumit will answer that question, but on the second question, probably if the high prices of raw material are concerned, the worst for the industry is over. That's what I believe. But for us, basically, probably Sumit can answer the impact on us.
Yeah. So in terms of inflation in the raw material price, as Amitji mentioned in his earlier answer, that in Q4 the oil price was around 110, 112 rupees per kg for the Q4 average, which has gone up to 140 rupees per kg, and that has now come down to 125 rupees per kg. So in terms of raw material inflation, again, Q1 seems to be higher than Q4 in terms of oil pricing, though we need to see in June month. But yeah, it looks that the oil price is going to be higher in Q1. So again, we are continuously working on various improvements, and now it has become the continuous process. So rigorously we are working on the channel optimization, including the direct distribution and other stuff. But again, as I mentioned earlier, there is a time lag between the price inflation and the benefit getting from these improvements. So there may be short-term volatility because of that, but yeah, in a medium to long term, definitely we can get to a much higher gross margin and EBITDA margin.
Fair enough. All right, sir. Thank you very much. Appreciate your answers.
Thank you, sir.
Thank you. The next question is from the line of Deepan Shankara Narayanan from Trustline PMS. Please go ahead.
Yeah, good evening everyone, and thanks a lot for the opportunity. Firstly, wanted to understand, are we planning to scale up our Awas Snacks business throughout the country or region specific? What are our revenue targets for this Awas Snacks once we reach nationwide kind of distribution level?
We will not be able to share the revenue targets. I think it's not prudent to share in this platform. However, we have successfully tested out Awas in some of the states. We have got very good response in Guwahati. We are getting some excellent response in UP, in parts of Rajasthan, in parts of Haryana, and we want to take it forward to some other states also, where we are having a third-party plants which can produce our products and market it at 200 kilometers, 250 kilometers radius, because that's where the logistics cost can also be optimized. So we are extremely bullish about our growth, and we want to take it forward and make it a pan India brand in next 1 or 2 years. Yeah, and Q4 has in fact, Awadh has already started growing at a double digit in Q4, and we see even in this year, full year, if we take the coming year, we see a healthy double-digit growth in Awadh. So as in fact, Awadh now has become the growth driver also. The expansion, both in terms of its portfolio and geography, has helped us.
Okay.
Does that answer your question?
Yes, sir, definitely. And more on that, so our snacks, how is it in terms of gross margin and EBITDA margin as compared to company's overall gross and EBITDA margin?
So ours is a slightly different business model where we offer more value as compared to Pratap. So it's basically a super value model, but it's actually lean distribution. So the distribution cost is pretty low as compared to Pratap. So our gross margin is relatively lower, but if you look at the EBITDA level, it's almost similar at Pratap in the normal scenario. However, in current scenario where oil prices are at peak, it has more negative impact in terms of ours because of higher quantity being offered. But yeah, in a steady state scenario, ours gives almost similar to Pratap's EBITDA margin.
Yeah, and we are also working on the portfolio of others so that we can increase the sales of those particular portfolios which has better margin. So therefore, in current year, this year, in fact, we foresee a much better bottom line for ours as we move forward.
Okay, so is currently our EBITDA positive at current year level, FY21?
Yeah, sir, FY21 it's EBITDA positive.
Okay. So lastly, what kind of investment do we foresee in next 3 years for increasing our 3P facilities across our country? And where do we see this contribution of 3P increase from current 24%?
We don't have significant CapEx because currently, if you see, currently we are underutilized because of this COVID, and now we are relying more and more 3P operations, which is anyway going to be the asset-light model. So we don't have significant CapEx plan. However, if you ask me about next 2 to 3 years plan, there could be investment of around 100 to 120 crore at the most, including all kind of CapEx, including maintenance CapEx, and some addition for packaging and production lines. And that will get funded by the internal accrual.
Okay, thank you and all the best.
Thank you.
Thank you. The next question is from the line of Chirag Shah from ValueQuest. Please go ahead.
Yeah, thank you for the opportunity. So first question is on, so due to COVID, is there any change that would have come into the company, say in terms of, category which started doing well, or say new channel emerging where you started focusing, which was not the say focus area, or any price point where you are seeing any meaningful pickups? So is there any change which you would like to highlight in terms of category, channel, price point, etc., which would have happened because of COVID?
In terms of one way of working, in fact, what we found that in top urban centers, the telecalling during this period has really helped us. So if we look into the telecalling in the 4 cities where we had already started last year, there the growth rate has come much higher than comparative other geographies during that case. So that's why we want to focus on that and take it to the next level to at least 200,000 outlets this year. In fact, we would have started already that plan in Q1. However, we are waiting for the lockdown to clear out. And once it clears out, we want to take it to the other cities and take it up. Apart from that, we have also seen, the products which are not that case dependent. For example, our other extrusions, apart from rings or chips, or even which we some of the new products which we have started, comparatively have done much better. And our foray into rural markets last year, where we started focusing on more, has given us results, because rural economy was less affected last year than the urban economy, and that has helped us because we rightly focused on rural sales, and that helped us to bounce back in Q4.
Right. Secondly, so if you see Q4, we have recovered very well in Q4. But now with this second lockdown, etc., and the more impact we are seeing in smaller towns, how has been business doing? And if you can just help us understand short-term outlook there.
Yeah, in fact, the impact of this lockdown is much severe than the last year lockdown. If you look at, because this year what we are seeing is that every person is getting affected, either him or the known ones. So the fear of COVID is much higher this time than it was last time. However, but if I compare with last lockdown, this time we are much better prepared, both in terms of our operations, in terms of running our factories well in advance, planning it, and also running us wherever. So whenever there is a lockdown easing out, we are immediately well-planned sales machinery is also working much better. So if I compare with last year same quarter, we are doing much better than last year same quarter.
Got it. And just lastly, so whatever changes you would have done in the business process, restructuring, etc., employee price increase would have taken, what kind of normalized margins one can expect, say, 18 months down the line when overall RM situation also start to ease out? So what can be, one should look at sustainable margins, say, 1-2 years down the line?
Hi Chirag, this is Sumit. So once the commodity cycle is eased out and we are also done with our plant changes, which is largely about the distribution restructuring, maybe in medium to long term we can look for 9 to 10% kind of EBITDA on a sustainable basis, because whatever changes we are making now, these are more permanent and sustainable in long term, irrespective of the commodity pricing. So on a long term basis, mid to long term basis, we are aiming somewhere between 9 to 10% EBITDA.
That is quite heartening. Yeah. And just lastly, what is the development on sweet snacks? What kind of size we have achieved and how that part of the business is doing?
See, sweet snacks, the entire segment which we are dealing with, again, as rings, it is extensively kids dependent, and a large portion of the sales is to happen. It is to get incorporated in the tiffin box of the kids when they go to school. So that category got affected because we were only dealing with 5 rupee products. So now we have started working on new products which can also come under 10 rupee bracket, and that product development is on. Hopefully in next few months time we should be able to launch a 10 rupee product introduce 10 rupee product in sweet snacks also, which can go home as a take home product. However, as similar to rings, as and when schools open up, the sweet snacks sales also will start again flourishing back. Yeah.
And what would be the size we would have achieved now?
So it's in line with FY20. So sweet again is roughly around 3% of our overall business.
Got it. Okay. Thank you and all the best.
Thank you.
Thank you. The next question is from the line of Jay Shah from OHM Portfolio Equity Research. Please go ahead.
Yeah.
Mr. Jay, so there is a disturbance coming from that line, so we'll move on to the next question. The next question is from the line of Dhruv Shah from Ambika FinCap. Please go ahead.
Yeah, hi. Thank you for the opportunity. Amitji, I have one broad question. Because of the lockdown, our growth has been captured in this current year. But going forward, how do you see our growth planning out with, we have 2 big players which are deep pockets. and other competition also building up capacity. In that scenario, how do you see our growth seeing once the normalization comes and once school reopens?
I think for the manufacturing facility, we have sufficient capacities available at different locations. In normal condition, healthy double digit should not be a problem at all. Healthy double digit growth.
Right, but don't you see competition being very aggressive? Because, what I understand that even smaller players like Gopal is also getting aggressive in our space.
Mm-hmm.
And being a listed company, we are more focused on doesn't that hamper our growth?
No, it really doesn't. Our clear focus is basically, we fight with the unorganized player, but our clear focus is basically to get growth. And the problem of getting listed is to basically work with margins compared to the unlisted player, but that's not an issue at all. We're trying to get margins by channel optimization and other processes, not by fighting these guys. So double-digit growth should not be a problem in normal conditions, not at all.
Right. Sumit, one question on your change in strategy and distribution. Doesn't it cannibalize our existing distribution? Like the super stockists wouldn't be selling our products, so doesn't it cannibalize because you're going directly to distributors?
What we are saying is that today we have intermediary. Okay, so I'm selling to super stockist. Then super stockist selling. He's acting as a hub. He's selling to the spokes, the distributor. Distributor sells to retailer sells to the consumer and consumer. So instead, wherever possible, where we are creating those hubs, instead of going through the super stockist, we will directly sell to distributor. So in that situation, what happens is then I can save one level of intermediary margin which I have been offering to the super stockist.
Right, but okay, but you don't see any impact on our sales growth because of that.
No. So in fact, that's why it will be in phased manner. That's why it can't happen overnight. So that's why we have taken the entire thing, the plan which we have taken out, which will be happening in next 10 to 16 months. It will take around that period of time. We have already started. Some places have already been converted. However, the entire plan might take 1 to 1.5 years time, and we should not see any drop or any issue with sales on that.
Right. And my last question is for Sumitji. Sumitji, we have been focusing on 3Ps for last longest amount of time. We have opened up 3Ps, but now we are focusing on opening up hubs. Doesn't it changes from an asset-light model to a capex-heavy model now?
Yeah, Dhruv. So the philosophy is still same. We want to keep ourselves asset light. So recently we took over the control of our Bangalore 3P operation. So Bangalore is the location which was completely exception to our routine 3P model, where we had invested in the plant and machinery. So there is no fresh investment per se. We just took over the control. Okay. Now we are running the operations on our own. Calcutta is a new location where we are planning to put up our own plant. But again, the putting up for our own plant, the philosophy behind is to make Calcutta location as a hub for Eastern market, from where we can plan direct distribution, as Subhashish has mentioned. Otherwise, still the philosophy is same. Any new location, the first preference is 3P.
Right. So, Sumit, how much capex will be needed to build our own hub in Kolkata and Hyderabad, which Amitji mentioned?
So, as I mentioned earlier in my earlier answer, Dhruv, we don't need significant capex. We are planning roughly around 100 to 120 crore for next 3 years. Calcutta would not require a significant capex. Part of the capex we already done last year because we placed the order and made the advances to various machine suppliers. The total capex for Calcutta plant is going to be roughly around 8-9 odd crore, where we will be producing extruded category because we already have a potato chips facility in Calcutta with a third party. So we will have all the products available at single location, which will help us to implement this direct distribution model in a faster way.
Right. Thank you and all the best, team. Thank you.
Thank you, Dhruv.
Thank you. The next question is from the line of Shirish Pardeshi from Centrum Capital. Please go ahead.
Yeah. Hi, good evening, Amitji and Sumitji. Thanks for the opportunity. I have a larger question on your direct distribution. You said that you are bypassing the super stockist leg and directly supplying to the rural. So what is the margin difference you save? I mean, I guess super stockist you would be giving about 3.5%, 4%. So is that a substantial number saving which we will have?
Normal, our channel margin to super stockist is around 3%, and 3% is the onward trade when the super stockist supplies to the distributor. So there is a 6% margin lying there. So if suppose take example of Delhi, we had around 60 distributors in Delhi, and we had one super stockist who was supplying to all these distributors. So we have made mega distributors in Delhi and directly supplying to them. So this all process we are directly supplying to these mega distributors rather than supplying to 60 distributors directly from the factory. And in the process, we feel that we can save almost 3% margin.
I got that. Having seen the operation on the ground, you probably are looking for a truckload direct shipment.
Right.
I got that. The point what I'm trying to understand is that how much such distributor who have this capacity to pick up the load. So I'm sure you would have done the maths and you have done the good logistics study, and you also guiding that there will be some saving which is coming. But I'm more keen to understand in any pilot or any specific state if this has been exploited. What kind of growth in the sales which has happened? That's the first part. And the follow-up is that to our overall sales, what is the contribution of this new direct delivery contribution?
So firstly, on the second question, basically we are targeting 25 to 30% of the sales to switch over to direct, including major markets like Delhi, Mumbai, Haryana, and Madhya Pradesh, and South Bengal. These are the 5 key markets we are targeting to go direct to the distributors. And second question, basically the sales, it has nothing to do with increase in sales. The sales will come from the basically distributor route where it takes a product into the market. So how efficiently it can do that is more important. So sales growth we are expecting by shifting all these mega distributors on telecalling. So the telecaller can take order one day before and the next day we can just deliver the stocks. Just to give you a flavor, if a SR goes into the market, he normally does around 40 calls, out of which normally 30 calls are productive. And if we can probably go through the telecalling, we can cover 50-60% more outlets.
Yeah, I got that. So what I was saying from the operational challenge, for example, if you're talking about a Delhi distributor and he would be investing, say, about 5 lakhs in a stock, and if your truckload which is going to come, his investment will go up. On the flip side, his market credit will come down. So I think, is it good for the distribution hygiene system from the distributor perspective, because you will be sending him a truckload and probably there will be a capacity constraint in terms of giving credit to the market or probably storage at his godown. So I'm saying I'm more keen to look at the qualitative aspect. Is there any such hitbacks which has come in, or is this going to be smooth ride for you?
Hi, this is Subhashish here. See, when we are talking about this direct dispatch to distributor, as if you recall, what Amitji was talking about a concept called mega distributor. That means before as a prelude to direct dispatches, you need to do a consolidation of distributors. Now, where the distributors can be consolidated, where we are relatively strong in the market. Okay. Now, irrespective of, forget about direct dispatch. Okay, even in a evolution of market demand and a company, as the company grows, at the initial phase you will be not getting big distributors. So you will appoint small bits and pieces, marginal distributors, distributors, and there will be huge number of distributors. However, as you get to a certain stature, as you cross certain level of turnover in a particular market, that's when one has to do a consolidation of the distributor. So instead of 100 small distributors, you might now work with 25, 30 large distributors equally, doing the same coverage, but with a much better pocket and much better financial and distribution capability. Now, that's the first step which happens. Now, once that happens, after that, you start directly dispatching to those distributors from the hub. And that's what is happening in Delhi first. So Delhi was one of our pilot markets. In Delhi, we used to have 60 small distributors and one super stockist. So instead of 60 small distributors, now in Delhi we have around 16 mega distributors. So these 16 distributors are handling the same geography, same coverage. Now, to help them out, what we are doing also, we are telecalling. Now, telecalling, I'll just give you a math. A telecaller on a particular day, in a single day, can call up to 120 plus outlets. Whereas, physically, when a salesman goes, can call up to 40 outlets with a ready stock operation. Now, that's the difference. So that means with same type of manpower, you can do 3 times the calls, and the next day, the distributor, the mega distributor, only has to just deliver the outlets who have ordered. So this entire process is, there are 2-3 steps. So first, we will do consolidation of distribution, appoint larger distributors in place of removing small distributors. Then we start telecalling, and then we start directly supplying to them instead of going through a superstockist. Does that answer the question?
Yes, Mr. Basu, I got it completely. Good handle on that. My second question is on the distribution front. Mr. Amit Ji has banked on the rural footprint. Could you please share what is the current footprint we enjoy in the rural markets, and any meaningful target you could share over next 12 months, and what is our internal target to expand our footprint?
See, exactly in terms of number of outlets, it's very difficult to share, because in rural, a large portion of the sales which we get in rural goes to the wholesale. Okay, but we believe in terms of consumption, around 45 to 50% of the product, yellow diamond and other products which are consumed in rural markets. So as last year progressed, the rural economy started bouncing back better, and our focus on rural helped that's why to get back the sales. So in terms of, that's why if you look into our entire top line strategy, it is based on 2 main pillars. One is the telecalling, which will happen in the urban centers. And what we are saying is a deep distribution by appointing distributors at every taluka level. Now, for example, if we look into a market like South Bengal, we have already completed entire taluka level distributor. Now, there we are looking at a block level distributor. Whereas in UP, now the drive is going on at district level distributor, and by the end of this year we will be able to do a taluka level distributor. So depending on the level of evolution of each state, we are actually going for a deeper penetration model, because that will help us to reach better, reducing our dependence as much as practicable from wholesale, and that will give us better returns also in rural market. There are some headwinds in rural market because the second wave had more issue in rural. However, still be able to manage, because the urban centers have started, wherever we have started telecalling, has also started performing better. So both these two put together will be, I think, both these steps will be complementary to each other. One for the urban market, one for the rural market, should help us in terms of getting our top line right.
Very, very helpful. Sir, my last question on the wholesale. You did harp on that wholesale is a key important channel. Would you be able to give a quantitative number of how many wholesalers we are covering in our stronger markets? I mean, the number, and what is the total revenue contribution which we are getting from wholesale at this time? I mean, if you can share.
Number of wholesalers will be difficult, but in terms of percentage of our business, it also differs from state to state. For example, if you go to Northeast, in some states of Northeast, even 60% of the sale might be coming from wholesale. Whereas if you come to Bombay City, hardly 10% of our sale is coming from wholesale.
I got that. For a company, how much is the wholesale contribution?
It will be very difficult. Approx will be around 25-30% at the most. Around 25%.
Thank you.
Yeah.
Thank you and all the best.
Thank you.
Thank you. The next question is from the line of Ayaz Motiwala from Nivalis Partners. Please go ahead.
Yes, hi, good evening, gentlemen. My question is on the larger competition.
Sorry to interrupt, Mr. Motiwala. Sir, your voice is not audible, sir.
Yeah, is it better now?
Yes, sir. You may go ahead. Thank you.
Excellent. Thank you. Sorry. I was wanting to know the key consumer differentiation proposition that you have on your products versus naming the larger competitors such as an ITC or a Pepsi, because your footprint and your aspirations are to be of that type of player. So how is this going to happen? On the trade side, rationalization, you have explained this very well. But in terms of from a consumer going to the trade side, what is the proposition for the trade for them to accept some of these new terms that you are talking about? If you could address both of these, please. Thank you.
Yeah. So in terms of acceptability in trade, I think over last, it's not that we are first time we are a new company going to the trade. In fact, especially in the C and D class outlets, in the lanes and by-lanes, in the small town and rural, we are more relevant than the names which you talked about. We are more relevant in those outlets as of today. And it has been built over the last 15 years. So it's not that we are new to a particular outlet, so in terms of acceptability. In terms of our proposition is that a much better value and at the same time best quality. However, in some categories we will give much higher value than some of the competition. In some categories we will be same to them. But over a period of time, Yellow Diamond has created its own brand pool, especially among the kids of 4 to 12 years old, ACCCD, where our brand name today also have started working. For example, in some particular category, we may not be giving any higher value than the number one brand, but still our sales happen because there are particular segments of consumers who are looking for Yellow Diamond chips. Did I make the point? For example, let's be specific. For example, if I take a Lay's chip or a ITC chip, since you name those two companies, in certain categories I will be giving higher value to the consumer. In certain categories I will be equal value to the consumer. But in those categories also we are growing because our brand is registered in our core audience, which is our target audience is ACCCD kids 4 to 12 years.
So just on the same point, just building on the consumer point,
that
you talked about, in your internal sort of analysis, and just if you can share some high-level thought on that. If you look at what these two competitors and some of the other players make, whether regional or single state players, a name like Balaji also comes in my mind from Gujarat, and since with other we are there. As you do benchmark studies, these margins that Amitji talked about and the direction of the margins, are you already in line with the competition, or are you substantially better than them, or how should we understand that aspect? As the current status is, and we are indeed going towards improving your status by the distribution rationalization points that we've already made.
Yeah, if you talk about Pricolia or IPC, we don't get the numbers, but we believe we are in line with them. However, in terms of regional players, there will be some regional players who might be having some regional benefits. For example, since they don't have to have the freight across India, they don't have a national presence, so they might have a better position. However, for example, if I do a P&L of my Madhya Pradesh business, then I'll be best in class. However, since we believe that for long term, our national presence is extremely beneficial for us for our long-term growth. Therefore, there will be some hit in the margins because we are national. We have spread ourselves. And if I talk about the companies you talked about, for example, Frito-Lay, ITC, I think we are quite in line with them. However, there will be some regional players who might be having better margins because of since they are regional in nature. And it also depends from product to product portfolio. For example, some categories have higher margins comparatively. Some categories have lower margins. I think we are one of the few companies which has the entire gamut, spectrum of salty snacks. So from that perspective, I think we are better placed for future growth also. For example, since you talked about ITC, they will not have namkeen, or they will not have extruded shaped extrusion business, or take Frito-Lay, they will also not have a lot of shaped extrusion or namkeen business. So whereas we are there in all segments of salty snacks. So I think strategically we believe and we felt that our presence in the entire gamut of salty snacks portfolio will help us to stand in better state for keeping future in mind. And that's how we are moving ahead.
So if I may just quickly ask you as a point that you laid out a lot of points in terms of the margin sort of expectation and what you just mentioned. So your gross margins today are 26%. You spent a small sum of 8 odd crores in terms of one can understand one of the big points of operating leverage typically in a consumer company. And this trade rationalization is going on. And you talked about the breadth of your portfolio, which we appreciate, but it should also be financially rewarding on a blended basis, let's say. So what are the points or the levers at a high level that you can describe, other than what Amit ji has described, 2 to 3 points of margin gain potentially over a medium term, and I'm just saying a name, a time frame. He's not spelled that out, but let's call it 3 years or maybe beyond, that will be or 9-10% EBITDA margin number. In this journey, sir, how do we better appreciate what are the levers on the mix side to get you improving gross margins on the product and the portfolio that you talked about, and then the other side of the cost that you're rationalizing beyond distributor? How are you benchmarking to see what are the other what is the other room for improvement?
Okay, let me answer and then you can tell if I got your question right. There are two, three factors. One, the product portfolio, of course, makes a difference. For example, rings is one of our rings and sweet snacks are two products which gives us highest gross margin. Okay. Now, in a particular year or in a particular phase where these two categories are challenged, there will be challenge in the overall margin pressure. So that is number one. So that's why we have we are working on different categories which can match their gross margin of these two categories. Number two, the oil price pressure is unprecedented now. To give you an example, our dependence on oil, and that's for most of the salty snacks companies, 5 rupee difference per liter of oil, per kg of oil, is almost like 1% EBITDA. So that's the type of, so you see in past 2 years from 60-70 rupees oil, now it is at 125 to 140. So we have taken huge gross margin improvement and productivity measures to be able to absorb them. Now, if I see if I have taken a normal a 5-10% inflation of oil, we would have been already at 19% EBITDA. With the type of corrections we made in our portfolio mix, in productivity, in freight cost, in channels. But that all those benefits got sucked into because of this unprecedented oil price increase. So as we start getting tailwind when the commodity prices cycle, also it's a cyclical in nature. So we will get this benefit. At the same time, what we are saying is we are not waiting for that. We will keep on working on these productivity measures. So therefore, we will work on the channel rationalization as Amitji was talking about. We will work on further on our portfolio mix rationalization, and at the same time, we will also work on our distribution of optimization, where we are talking about telecalling in urban, deeper distributor network at each taluka level for the rural, and that should help us to get to the optimum, bottom line level, as we are saying, as Sumit has shared. Does that answer your question, or?
Yes, sir. So this is very helpful, and we wanted this kind of sort of color, and I really appreciate. I wish you, the team, and Amitji and others, all the very best. These are very trying times, and I mean, we do really appreciate the business in the light of these tough times, but it's also, of course, to sort of learn the business in a better light. So it's been 2-3 years only that it's been listed, or maybe 4. And it has been facing some of these headwinds along with new product introductions that you all have gone through, the sweet snacks that we talked about. And so it's just up to us to learn. So thank you for that, and all the very best.
Thank you so much.
Okay, thank you.
Thank you. The next question is from the line of Kalpesh Sontake, an individual investor. Please go ahead.
Question.
So your voice is not audible, sir. Mr. Sontake?
Yeah, is it out now?
So your voice is breaking, sir.
Audible now?
Yes, sir. Now it's audible. You may go ahead.
Yeah. So sorry for that. So I had a couple of questions. So my first question was the quarter four sales almost touched the FY20 Q4 sales. And can you help me? Can you throw some light on how you achieved the numbers on the measures which you have adopted, given the schools and colleges were closed, and also the travel has been subdued in the last quarter?
Yeah. See, we shared that earlier. Well, we have got headwinds in terms of schools not getting closed and the kids not going out and the travel channel getting affected. So at the same time, what we did was that we started focusing on telecalling in some of the urban centers. And what helped us mainly this last year was that we started deeper rural penetration by appointing distributors at taluka level. Because in the first wave of COVID was last year, if you see the first wave of COVID, rural was less impacted than urban, and our focus was to augment our distribution capacity in the rural to make it up for whatever shortfall we were getting in urban. And because of this travel channel and schools, that has helped us and to bounce back in Q4.
Okay, thanks a lot. That answers my question. My second question is, do you see any impact from the entry of Cornetto's brand in economical segment? They are now expanding their operations on e-commerce side as well. So such upcoming brands, yes.
See, our major focus is general trade, and that is our strength.
Okay.
Our dependence on e-commerce is hardly there. In fact, because our 75% of our sales, 80% of our sales comes from rupees 5 pack. So our focus is still around. However, we have increased our contribution of larger packs, which was around 5-10% 2 years back, now to 20-25%. But still, our major sale we are dependent on 5 rupees and general trade. and that's where our focus will also lay. And we don't think Cornettos coming in the other segments will affect us. It will be same like any other company who is launching. India is a very very big market for many companies can come in. That's
Right. Thanks a lot. And my last question from my side is, can you share the revenue contribution from our the sales contribution in Q4 as well as the FY21?
For the whole year, Awadh has contributed almost 160 odd crore, and that is almost similar to FY20. It's a very slight decline that is primarily on account of closure of operation in Q1. But if you see the Q4 there is a positive growth in Awadh. It was healthy double-digit growth.
Okay. Thanks a lot, and all the best for your upcoming quarters. Thank you.
Thank you.
Thank you. I would now like to hand the conference over to Mr. Ashutosh from Systematix Institutional Equities for closing comments.
Yeah. So on behalf of Systematix Institutional Equities, I would like to thank the management for taking out time for the call. We are also thankful to the participants for making the call a success. I would now ask Malika to please close the call.
Okay, sir. Thank you. On behalf of
Thank
Systematix.
Thank you. Thanks a lot. Yep. Thank you, sir.
Thank you. On behalf of Systematix Institutional Equities, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.